Hey, thanks for tuning in. Today in this video, we're going to discuss the concept of balance areas, excess and range trading, hard market, easy market, trend mode, etc. All of those concepts I'm going to try to put that puzzle together for you. And in the example, we're going to take a look at NVIDIA. So this is a weekly chart going back almost 3 years now, and she has a great example of price discovery, trend mode, impulsive waves, Elliott wave, all that stuff is also here. You also get the trend following, hey, we've lost the 40, we recapture the 40, we retest the 40, we retest the 40, and this is a trend, and it is your friend until the very end, right? You get all of those things wrapped up in NVIDIA. So it's a great example to look at. But for this video, we're going to talk specifically about the concepts of balance. All of these concepts come from James Dalton, Mind Over Markets. Those books are in the tutorial section. I recommend everyone goes reads them. Also, some of these rules are taken directly from shadowtrader.net/glossary. They are free. Everyone go take a look, apply them in your trading. But the two things that we're going to start talking about here are when the market is in excess, or right, there's a supply-demand imbalance, either favoring the bulls or the bears. With NVIDIA, this has been bullish, right? So there's been a supply-demand imbalance favoring the bulls. What the different scenarios are when that happens. Also, we're going to take a look at the role of the moving averages, the probability of them working when you're in price discovery versus the probability of them working when you're in balance or in a correction. Elliott wave and moving average followers would just simply say, yeah, that's a correction, right? And it's one of these corrective waves, or it's a correction we close below the moving average and it's sloping down. So all these systems look at the exact same concepts the same way. And really the goal of it is just identifying it and then taking a weight of the evidence approach, add it to your toolkit, and take the setups. So, all right, that's enough of the intro. Here we go. So when you're in excess or trend mode, what you tend to do, and that's where we are right now, this is the most current week, you tend to just fall into a look above and go, look below and go, look above and fail, look below and fail type setup. This is a look above and fail, where she fell back into the middle of balance. The moving average once again confirmed demand. So at this point, 6 times the bears tried to get through the 40. They failed. Supply diminished. Bulls came back. You then had a beautiful look above and go setup. Well, the look above and go setup targets the other side of balance. So let's talk about how we got into balance. So the March lows happened. This is your little zigzag correction, very steep wave 2 correction of this move. And when the pandemic started, NVIDIA was a huge beneficiary and really just went straight up because this balance area was broken, this high here to this low here. And she trended all the way up until she found supply August 31st. You have this really, really massive wick on both sides. That is a reversal candle on volume on the weekly chart after a very large move. So this was caution for the bulls. Ultimately, she never left this range for 5 months. And when she did, there was too much supply, and it set up a look above and fail. Now, when you have a look above and fail, you target the other side of balance. And I want to be clear, the balance, it's not like I came up with these levels, right? The balance is just this range. It's this candle. It's the high and the low of this candle. And if you move out to a monthly chart, it would be the same candle. So this is a balance area on the weekly and monthly. And when you get a candle like that on the weekly and the monthly, it's pretty impactful, especially when there's lots of volume. And really, that's the most volume that showed up since the correction that started back in March. Okay, so this look above and go scenario that was set up here on the 8th by closing above failed. Right, the bulls got 0 follow through. Now they did close 2 weeks above, but they got no follow through for 10 sessions and immediately went to the other side of balance. Well, when you get to the other side of balance, that was the setup. The setup was to sell here and then cover here. That is what smart money did. It's also, in my opinion, what we call an ABC flat. This is an Elliott wave correction that ended March 8th, and that is when the new impulse wave began, or when price discovery or excess began. You have here another look below and fail, which targets this side of balance. When we got here, that became the sell again. You did find sellers. She came right back into the 40 and then set up your look above and go. So that's how we used the balance rules, which are found at shadowtrader.net in the glossary, to our advantage, right? The look above and go, the look below and fail, right here, the look above and go, the look above and fail. So you've got a whole bunch of scenarios here. Now, when you're in balance, which is the second area, the question is how do we trade and make money and manage our risk? Well, really, the risk became the high-low of this candle. And what you should be doing while in this is simply range trading and assume that you will not break balance. Just assume the assumption you're not going to break balance, at least for the second or third attempt. NVIDIA is a great example. First attempt up here, came up to the top of balance, found a lot of supply, went back inside, collected a whole bunch, really did nothing, was dead money for almost 2 months, 3 months. Really, the range did not move. The bulls tried again, second time, failed again. So, it really took 3 times to break. Again, I'm trying to emphasize that while in balance, the assumption is you will not break out. And that if you do break out, it likely won't happen until the third attempt. Now, when you're in balance or in a correction, an Elliott wave correction, the role of the moving average is really just to tell you that the correction has started. So losing EMA 5, hey, we started the correction. But in general, the moving averages during the correction aren't going to be your buy-sell indicators, right? We're going to be looking at horizontal price levels. We're going to be looking at Elliott wave structure. The role of the moving average and the probability of them working and providing demand is essentially a lot lower than it is during a trend. Like, look at this trend here. We're just riding the 5 and the 10. And really riding the 40 since she captured it back here in August of 2019. But the slope of the moving average will tell you that, hey, look, the probability is that we're gonna come back into the 10. Maybe we'll get a bounce the first time we touch it, which is what happens here. Came all the way back up and then failed, closed below it, right? Back above, back below, below above, below above. Obviously, this isn't telling us that the trend is changing from bull to bear, from bear to bull, from bull to bear. It's telling you that there is no trend. That's it. So during a correction or during your, while you're in balance, which is where the market likes to live, while in balance, the moving average is providing a trend environment is very low probability. And what's more probable is the slope of them will all go to 0, which is exactly what you have here in a very bullish chart. This is what you want to see. You want to see a pullback. You want to see the moving averages rise up to price, and then the distance between all the moving averages get to as small as back here when the trend began. And you take a look here when the correction started. I mean, the distance to the 200 is very high. Very, very high. Same here. So there's still a big risk, but the reality is, going back to 2019, she hasn't touched her 200 on the weekly. And a good price for NVIDIA is the 40. Now, in balance, the significance of Elliott Wave is the puzzle, right? There's only a handful of corrections that you have to master: the zigzag, the flat, the WXY, and then the triangles. And there's variations on each, but while you're in balance, this is where you're going to see, when excess ends, I guess is another way to say it. That's when you're going to have to know all your patterns. And that's really where all the money is made in Elliott Wave, right? An impulse, this is easy. This period, this is easy money. March 20 to August 2020. That was the easy money phase. It just went straight up. Oh, this is an impulse wave, right? 1, 2, 3, 4, 5. Doesn't matter how you count it. It just went straight up. But once you had this candle, that's when you really needed to understand, all right, what is this? Is this an ABC up, an ABC down, and then a 5-wave move down on the daily? We'd have to zoom into the hourly, right? Try to get the picture. In hindsight, it's pretty obvious, right? They broke this low and reversed. That's a flat. That's what flats do. This is a zigzag. Straight down. Feels horrible. 4 weeks straight down. 50% correction. This correction is very shallow. This was easy to hold through if you were a buyer back here. If you were a buyer back here, this was not easy to hold through. So during your correction, or when excess ends, or when price discovery is over, that's when you really need to pull out your Elliott Wave corrections and understand how to map how they're carving up the 2D space. Because really, this is just a 2D chart with time on the horizontal axis and price on the vertical axis. All right, well, that's about it. I hope this helps. If you have any questions, reach out to me on Twitter or check us out in YouTube. Like, comment, and subscribe on the video. Thanks.